to tell us. Latha, this should be read positively?
Well, I would read it terribly positively. It's not a near-term bond yield thing. This is an agreement signed in February between RBI and the government, saying that RBI has been given a target by the government to keep inflation at 4%, plus or minus 2%. So at all times, inflation should be below 6%. It goes on to say this MPFA, Monetary Policy Framework Agreement, that if it is above 6% for 3 quarters in a row, RBI will have to give a written explanation to Parliament and to the government. So they have a mandate to keep it down. Now remember, the signatories to this are both RBI and Government of India. So this is a very major agreement that the government agreed to. If RBI says in its letter, we were willing to do it, but you blew up the fiscal deficit, then the ball goes back and the government is equally committed to that target. As well, if the RBI finds that the fiscal deficit is not helping, that it is being forced to print too much money, which is pushing up inflation, then they can also increase monetary, interest rates. The government can't, literally morally arm twist it because you gave us the target. And now why is this announcement important? There were people saying that probably RBI has put in a rather difficult target of 4 plus or minus 2 in the MPFA. And therefore, should we wriggle out of it? Should we change that target? There was that fear. But by notifying this, which the Finance Ministry official says will be done later in the day, the government is standing by the agreement that it signed with RBI. This is very important because long term, as well, Nigel, what has brought foreign investors into India is not earnings growth until now. For the last 3 years, earnings growth has been practically flat, but macros have improved. So this recommitment to good macros to keep inflation down is, I think, something which will go very well with foreign investors. See, when you allow the rupee to remain steady, to buy the same amount of goods and services that it bought last year, it will buy the same amount of dollars as well. So your currency, your exchange rate also is stable when you have a stable inflation. And that also attracts investors of all hues. So this is a very good comment on India's macros. There is a lot of unsavory or a lot of noise about what inflation should be and what interest rates should be and how interest rates are impeding growth. Amidst all this noise, if the government is able to stay its ground, the word it gave in February, I think it will be seen as extremely positive. You might see it as negative for stocks because, the RBI has been allowed to keep its, 6% upper bound on inflation. We are at 5.8. A central bank which sees inflation at 5.8 will be in no position to cut rates because, after all, they are answerable above 6. So technically, rate cuts will come now only when inflation meaningfully moves away from 6%. If it is moving closer to 6%, you cannot morally expect a rate cut. So stock markets can read that as negative, but I don't think anybody will be reading it that way. And an immediate loss of one rate cut is something that can be given, provided the ultimate benefit is strong macros for the country.
So for the medium term and long term, the benefit is, stable and strong macros, though in the near term, the rate cutting cycle of the RBI could slow down. But let's get in some reaction.